Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's Thursday, the 24th of November, and we have our regular Thursday guest, David Kuo, founder of the Smart Investor Singapore. David, good afternoon.
Hey, selamat tengah hari, Brian.
Well, selamat tengah hari, David. Now, David, we're going to come back to you and get some of your sagely insights after we take a look at how markets in the region have been performing. But we're going to start with the crypto markets. Bitcoin is at 16,695. It's up 1.18%. Ethereum is at 1,203. It's up 3.42%. Now, looking across to the regional stock markets, we start with the Straits Times Index. That's down 0.11%. Bursa Malaysia is up 1.62%. Shanghai is down 0.07%. The ASX All Ordinaries is up 0.27%. The Nikkei is up 1.1%. The Hang Seng is up 0.57%. The Kospi rounds up the numbers and it's up 0.88%. David, pretty good numbers compared to your normal Thursdays where your numbers are all in the red. Tell us why.
I know, I need to pinch myself. Is it really Thursday? Because, I mean, normally Thursday is a sea of red. But I think generally what's happened to Asian markets is that they've picked up the baton from the US. We had finally, I mean, those long-awaited Fed minutes, and people were digesting what the Monetary Policy Committee was doing. And they've decided that, in general, it doesn't look too bad. And so consequently, Wall Street was up. And then that followed on through into Asia. Of particular note, I think, is probably Hong Kong and where you are from, Malaysia. I mean, the KLCI is up because finally, I think we have some resolution to the general election. And it looks as though there could be a new prime minister, somebody who's a little bit more moderate and probably slightly more reformist. And so therefore, that is giving investors confidence to go back into Malaysian shares. Hong Kong is slightly different because we heard today that China is likely to ask the banks to reduce their reserve requirement ratio, the RRR, which is another way of saying put more money into the economy and get it growing again, because they desperately need to somehow try and revive growth after an entire year of being in the doldrums. But having said that, the COVID cases are rising in China also, which could mean that even if you cut the RRR, Chinese economy is unlikely to sort of grow at gangbusters just yet, and we'll have to wait until COVID starts to abate over there, Brian.
Now, David, the messaging that was out from the Fed was a little bit more dovish than previous messages. What's your view on this, and have people perhaps interpreted it to the other extreme?
Okay, right. I mean, it depends how you want to read those minutes. I mean, there are two ways of taking it. Some people are saying that, hey, we've reached peak rates as far as the Fed fund is concerned. And so they're saying it means that the Fed isn't going to be increasing interest rates much more after this. But then if you read the other side of what the Fed said was they're going to be slowing down the rate of increase. They didn't actually sort of say that they were going to pivot and start cutting rates. So I think some people were jumping the gun slightly. What the Fed was really saying was that inflation is still a problem. They've already increased interest rates quite aggressively up until now. So what they may do is to slow down the rate at which they increase interest rates, but the peak rate may actually be higher than what they previously had forecast. So therefore, it's a bit like removing a plaster from a wound. And the wound in this case is inflation. So do you rip the plaster off all in one go, which is something my mother always used to like to do, or do you peel it off slowly, which is the way I like to do it? And so I think a lot of people are leaning towards let's rip the plaster off slowly rather than to rip it all off in one fell swoop. So I think interest rates are going to remain high. And I think they're going to be high for a lot longer than people expect. And don't expect any rate cuts anytime soon, Brian.
Now, David, the other thing that's worrying investors' minds is really that R word, recession across the globe. Starting, of course, now very much so in places like the UK and the rest of Europe. But the OECD outlook for 2023 was interesting because it did suggest that emerging markets of Asia could be one of the few growth areas in the world. Could you share your insights in terms of why this may be the case and what was the outlook all about?
Okay, it's not entirely surprising what the OECD said. What they forecast is that global growth next year could be around 2%. But given global growth is 2%, they said that there will be pockets of higher growth and areas of lower growth. The two areas that they are most concerned about in terms of growth is the United States and also Europe. And they think that both of these economies may actually go into, if not slower growth, almost recession. And so where is that 2.2 global growth going to come from? They highlighted Asia, the emerging markets in Asia, as being a bright spot. They singled out one country in particular. They said that India could grow at around sort of 5.5% next year. So essentially what they're saying is that if you are a stock picker, well, this is the way I read it. If you are a stock picker and you are looking for some kind of growth, then you really need to be sort of looking at our region over here. And it's not really that surprising. If you have a look at countries like Vietnam, Malaysia, Indonesia, Philippines, I mean, these are growth areas. And these are also countries that seem to have handled COVID quite well. And they've also handled the debt situation reasonably well. And so if you are a stock picker, you should be sort of looking at these kind of areas for growth next year. Of course, everything could change halfway through the year, and then OECD could come up with a new report. But for now, I kind of understand what they're saying, and I do, in fact, believe that this area could provide the kind of growth that investors are going to be looking for, Brian.
Now, David, I want to swing over to the other side of the equation, and with far more volatility, crypto markets. Now, it looks like there's going to be even more contagion and volatility with signs that people like Genesis could be going under. Could you give us some insights into your thoughts on this area?
Well, the thing is, Genesis said that they need more funding. They need more cash. And what is really not surprising to a lot of people is that a lot of these platforms appear to be somewhat incestuously linked, and they seem to have been borrowing off each other and lending to each other. And so consequently, once one goes down, they're going to take everybody down with them. So the problem that we have, Brian, is that these companies are very, very opaque, and we don't really know what is going on inside them, who has been lending to who, and who is indebted to who. And so it is only when something happens, only when a company comes out and says, we need more funding because we're not going to be able to honor the redemptions that people, if they want to sell their cryptocurrencies, in other words, they've run out of cash. And I think this is partly due to what is happening in terms of quantitative tightening and the raising of interest rates. People are saying, well, okay, interest rates are quite good at the moment. Let's cash in my cryptocurrencies, whichever one I have, and then I'll take that money and earn 4.5%, maybe 5% somewhere. And then you suddenly find you can't take your money out because somebody's actually locked the door and say you can't take it out because I haven't got the money to give you. That is when problems start to arise. So nobody wants to be the last person in the queue waiting to collect their money. And unfortunately, I think there could be more casualties, just like FTX and maybe Genesis, unless, of course, they get some funding from somewhere, Brian.
David, on that note, thank you very much for your insights. Thanks for coming on the show.
You're welcome.
Now, we've been speaking to David Kuo, founder of the Smart Investor in Singapore, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.